Welcome to the daily update, where I'll go over the action in the market for Thursday, December 7th, and then we'll see how things look for Friday, December 8th. We're still range bound overall. After Wednesday's session, we pretty much were at the bottom end of this range. After Thursday's session, we're back at the top of this range as the market is pretty much treading sideways. And we'll have to see, is the employment situation report going to come and bring some clarity into the market? Now, typically what will happen with this is the market will come in as friendly, and that can take us higher. It could come in as unfriendly and take us lower. The most frustrating thing would be if it's mixed. There are parts that are friendly and unfriendly, and we end up chopping sideways. So there's some anticipation of this, hoping that something will get worked out. We're still looking positive overall. There are some areas of weakness. There are some areas of strength. So we'll have to see how the tug of war goes back and forth. Right at the open, we did have a gap higher open, and then we went above R1 at 45.78. As the day went on, prices climbed and actually hit resistance at the 45.90 level. That wasn't a pivot level. It's just a round number that the market hit and then started to come back down. We chopped lower going into the close, and we closed right at 45.86. We were up 0.8% on above average volume. That's still continuing. We are positive, but there's some weakness that's developing. There's momentum that's starting to turn more negative. We have a few of our intermediate term charts that are switching over to negative. Now, the market could get that back with a good solid up day, or it could continue to turn more negative if we have some kind of a down day. If we chop more or less sideways in Friday's session and then end that way, we're probably just going to continue to show some areas of strength and weakness overall. It's all about the employment situation report in Friday's session. Let's hope that that does give some clarity. We're keeping an eye on the geopolitical events, specifically what's happening in Israel. Some comments that we can make. This was another day and on Thursday where the mega caps performed well. They pretty much kept the market higher, where the broader market saw some more weakness. Oil ended up closing down just a little bit again at $69.30. The yen really jumped up when compared to the dollar. Now, it's been in a longer-term downtrend. And if you watch the intermarket analysis video that I do each weekend, you can see that there's a solid downtrend. We'll have to see. Is this going to shift over into the yen starting to outperform the dollar, or was this just a bounce before the yen starts going back down? There was some speculation that the Bank of Japan, they may be shifting their policy, and it might be happening sooner rather than later, and that really helped to strengthen the yen. There's some real strange things going on in Japan that so far haven't had a major impact, at least over the long term, on the U.S. markets. I'm keeping an eye on that. If that starts to develop into a situation, I'll be certain to talk about that. The parabolic SAR chart still continues to be negative. We haven't really broke out above this range that we've been in, and so the parabolic SAR just sticks with what it was already calculating. On a short-term basis, we have a few more things that are being added because we're chopping around, and it's too bad the ADX isn't picking this up. The ADX indicators, that's what we use to measure whether we're trending or not. They're still suggesting that we are trending, but it's obvious by just looking at a price chart that we've not been trending lately. But personally, I go with what the ADX is saying, not necessarily what I think will happen going forward. I don't like to play on hunches. I prefer to look at concrete evidence, at least as concrete as we can get. But our short-term list, we do have the ADX. It's still above 40, still suggesting that we're in a trend. Even though the green line is still declining, we are still in a positive trend. The Williams percent R is on the list, as is the CCI 14. The 20 is not on the list yet. The stochastics are starting to show, at least in the short term, a little bit of an extreme reading, or we're still looking extreme with our longer term stochastics. The PMO oscillator, yeah, it's rolling over, but it's still extreme positive, and the same thing can be said with the slope oscillator. Intermediate term, we have the PMO studies, the BPI for the NASDAQ 100, the new high, new low study based on 10 periods for the S&P. Notice that there's not an oversold indicator now. The Stoch RSI, which was extreme negative for a couple of days. It's gone back up now and it's more neutral. The current scenario is the same, and we'll see if any more clarity comes into this scenario in Friday's session. The Fed is keeping rates higher for longer. The debate goes back and forth as to, are they done? Are they going to have to raise rates? Are they going to keep them the same? And that goes back and forth pretty much on a daily basis. We're keeping an eye on what's happening in Israel. Not really watching oil as close. Of course, we're watching the price, but it's not having a real impact on the markets right now. And then we're getting near the end of earnings season, so it's not having as much of an influence as it was a few weeks back. The dollar was up and interest rates were also up, even though we had an update for the S&P. Sometimes both of these can provide some headwinds for stocks. We still have the 10 to the 2-year and the 10 to the 3-month yield curves that remain inverted. Sentiment is still positive. With the update, we ticked up to 64 where we had been at 63. Our trend is positive. We're above the moving average. We're above 20. We're getting close to 40 with both charts, but we're above 40 with the short-term chart. Our bias is positive because of the update, and I've kept our momentum at mixed for right now. We've had a number of down days in a row and then an up day, and we're range bound when you look at the chart. So I'm just keeping it at mixed for the time being. The economic reports that came out. We had the weekly jobless claims, which came in a little less than expected at 220,000. They had expected 223,000. Continuing claims came in at 1.861 million, and I have charts of both of these to show you. Wholesale inventories were down 0.4%. That's more than the down 0.2% they had expected. Last time it was unchanged. Consumer credit came in up 5.2 billion. They had expected it to go up to 9 billion. Last time we had the report, it came in up 12.2 billion. So a little bit less folks are using credit these days. Here's some charts. Here are the weekly jobless claims where we did go up just a little bit with the claims. We mainly watched the blue line, which is starting to flatten out now. We had been declining, and then we were starting to go back up. Now we're starting to level off with the weekly jobless claims. It shows that, yeah, we're not really decreasing. So the employment situation isn't really strong according to these reports, but it's not necessarily weak either. We also look at the continuing claims. This is folks that go beyond just 1 week of being unemployed. It's coming down, but if you look at the blue line, we're continuing to go up. So we're getting a little bit of a cross signal there in the short term. Here's when we take everything together. The red line are the initial claims, which they ticked up just a little bit. The blue line are the continuing claims that came down. The current unemployment rate is at 3.9%. That will be updated in Friday's session. Looking at consumer credit on a year-over-year basis, it has been declining. Interest rates are really going up. Credit card interest rates are really high. And so you have folks that are really reluctant to use a lot of credit, but some folks may have no choice. They're using credit just to get by on a month-by-month basis. We did tick up just a little bit with the 10-year yield to 4.13%. Overall, we have been inching down to that 4.02% level. It would really help the market if we could get below that 4.02% level. That might induce some more enthusiasm for corporate earnings going forward. Here's our intraday chart where we did gap higher above the daily pivot, and we're very choppy in here. We came up, went above R1, and then a sell program hit, and we shot right back down. We never did fill the gap from Wednesday to Thursday. Then we came right back up, went above R1. We came up to 45.90 and then drifted a little bit off of that going into the close. Here's our intraday chart where we were looking more positive in the pre-market session. The futures were quite strong. That carried over into the open, and then we saw a little bit of weakness going into the close, and we're pretty much flat right now in the initial overnight session. We're still seeing where value is outperforming growth. The red line is above the blue line, but they were both positive. When we look intraday, we did see a real spike up with the S&P growth to value ratio. That's encouraging, and then we were able to hang on to most of those gains as the day played itself out. Some end of day charts where growth was up more than value. Excuse me, with the large caps, we underperform with the mid caps and also underperform with the small caps. So this were the This was a day when the big mega caps really outperformed. But when you look at this growth to value ratio for the end of day look at the S&P 500, we continue to decline with this ratio. Longer term, we're still in an uptrend, but we've been really range bound with this ratio for quite some time. We want to see this turn and go back up, and that's just not happening yet. When we look at discretionary versus staples, we tick down just a little bit, but we are seeing some improvement when we take a ratio between discretionary and the staples sector. Keeping an eye on our trend, this is the intermediate term chart where we're still above the moving average. That suggests we're trending. The green line is on top, even though it's declining, but we still default to the positive side. We're still extreme with the short-term ADX chart. We're just continuing to climb up, and there's really no sign of this rolling over, at least yet. However, we still default to the positive side because even though the green line is declining, it is on top. Volume, we're kind of scooting in at about average now overall. Looking at sentiment, I still think that we could possibly be in this real choppy time right now before things turn more positive as we head more into the middle part of December. The Ulcer Index ticked up just a little bit, but is showing that fear is really non-existent right now. Folks are not really afraid, so sentiment is quite positive. When we look at the line chart of the VIX, we did tick up just a little bit, and we're chopping more or less sideways with the bar chart. We're below the moving averages with both, and the moving averages are declining, showing that there's not a lot of fear, or taken another way, that there's a lot of complacency in the market. You have a lot of folks that are assuming that the market's going to go higher from here, but the market doesn't always like that and can really throw a curveball into the whole situation. When we look at the VIX of the VIX, volatility is still below the moving averages, both with the bar chart and the line chart. We've been pretty much chopping sideways. The VIX to VVIX ratio continues to decline, which is positive, and the VIX to the 3-month average of the VIX is also declining. The VIX to move ratio is chopping around after really dropping lower, showing that there's just not a lot of volatility in stocks when you compare it to bonds. The equity put call ratio is pretty much flat on the one-day chart. We're still down here near this extreme negative reading. Now, we can always drop below this. This is just an arbitrary area that I picked out to put a line on the chart. We could go down further than this before we potentially bottom out with the equity put call ratio, which means we might top out with stocks, or we might jiggle around sideways more or less and be able to work off getting close to this extreme reading. Because when you look at the longer term chart, we can go well below this line that I have here. Doesn't mean that we're just necessarily going to stop here and turn and go the other way. There have been pretty positive signs when the market's really been going up that the equity put call ratio has been declining. Longer term, with our 253 period moving average of the equity put call ratio, that's positive because it's continuing to look more decisive as it's going down. This fear gauge continues to fall off. The other fear gauge also ticked down just a little bit, but wasn't that pronounced in Thursday's session. We saw a little bit of an improvement with the risk on to risk off ratio. It's starting to show that it's going back up a little bit. Longer term, though, we have been declining. But this is what we've been seeing. We see a couple of good days and then we pull back. A good day, and then we pull back. Well, on Thursday, we did have a good day, but we want to see some follow through and see this start to turn more positive. We did get the latest reading of the American Association of Individual Investors. They had come almost up to this 90 level, which is not necessarily extreme, but as we've been running into some problems over a week ago now, this has been dropping off in the market, so they're not as optimistic as they were before. Looking at our advanced decline line studies, we did turn up based on price and volume, and we're well above the moving average. We're going sideways with the 5 period and actually declining with the 10 period when we look at the new highs, new lows. New highs are picking up, but they're dropping off overall, and we're just not seeing a real expansion of the new lows. So the strength inside of the S&P is still hanging in there for right now. We turned up just a little bit with our advanced decline ratio, and we're above 0. That's positive. Accumulation distribution did turn back up, and we're above an advancing moving average. That's positive for what the smart money is doing. Here's another look at the smart money where this continues to drop off, but it's still positive with the Chaikin money flow. At some point, we want to see this red line turn back up and go positive if we're going to get more positive looking at what the smart money is doing. Looking at the cumulative advanced decline line, we are showing some improvement here. I took these lines off. They don't seem to be really applicable anymore. And we saw a bit of a tick back up here with our regular NYSE advanced decline line. The other NYSE advanced decline line still is showing some improvement. We're above both of the moving averages. And looking at our advanced decline line studies, we turned up with the common stock for the NYSE, the S&P, the mid caps, and the small caps. So we saw more across the board strength when you look at the advanced decline lines. Our short-term chart, see how we're just coming back up into the top end of this range. We have some pretty significant overhead resistance. This would be the July 31st high if we could break above that and then close above it. If we do go up, this will likely act as overhead resistance. We have a longer term look at that. And then just a few days ago, we tried to get up to this level and we're not able to get above that. So if we could close above that, that would turn things more positive. If we end up having a down day, we might just likely come to the bottom end of this range. We'll be watching this because if we really start to drop, that could turn things more negative. On the bottom, we are above average with volume. Here's the Williams percent R, which had worked off not being extreme positive, is now looking extreme positive. The CCI 14 also had been extreme positive, worked that off. Now it's starting to get extreme again. The force index did show some improvement, but it's still below its midpoint, and the midpoint is declining, but it's positive because it's green and above zero. Here's our short-term stochastics, which had worked off being extreme positive. Now it's back to extreme. We turned up, but we're not extreme in the intermediate term. We're still flat to slightly declining with the long-term stochastics chart. And we're right on the border between the +2 and +3 standard deviation with our Keltner band study here. This is not a real big concern right now, but if we do have an up day, it might limit the upside potential, especially if we're not able to break out above these previous highs. Some intermediate term charts, we ticked up just barely with the balance of power, but we're positive because we're above the midpoint. The go, no-go system, it doesn't like this sideways action. So the last couple of bars now have turned to a lighter shade of blue. And with our highest high value, we've also been chopping sideways. The midpoint continues to advance. Another positive thing is the red line, which is the lowest low value. It has really been coming up lately. And so we're not seeing a really wide spread between the blue line and the red line, just as we've been going sideways. The TTM squeeze continues to be positive, but it is declining with the darker blue bars, and it's no longer extreme positive. The ease of movement continues to be flat, but it's still above zero. That's still positive. The Erin indicator is coming down slightly because we're seeing the green line decline and the red line flattening out. As I've been pointing out, you could suggest that we saw an extreme positive reading with the oscillator, and that's why it is now pulling back. The summation index based on price continues to advance. We're flattening out, but we're still pretty much declining when we look at the summation index based on volume. Sometimes this is a leading indicator for us, but it can also give some false signals. There are times when it looked like, okay, we were starting to turn down and then we recovered from that. But there's been other times when this started to turn down or up before we saw a corresponding move in price. When we look at the NYSE summation index based on price and volume, this is still advancing. This is another warning sign. The Swenlin trading oscillator based on price and volume, especially on price, we're declining where we're pretty much flat, but we still have been declining based on volume. Here's the PMO where we're above this red line, starting to roll over, but we're still positive, showing a little bit of weakness here based on price and volume, but they have not crossed below their moving averages. We're no longer extreme with the PMOs that are rising, and we saw that tick up. We're no longer extreme with the buy signals. We're just barely starting to come back down now, but we are extreme when we look at the PMOs that are above zero. We continue to be neutral for the Elder's Impulse system on the S&P 500, and we have another dot here with the parabolic SAR. Now, if we can break out of this range, there's a chance we could get the dot back underneath. If we go sideways, we're probably still going to see the dots on top. Usually when there's a change in this indicator, it tends to last for a while, but not always. Here was a 4-dot signal here. Here was another 4-dot signal. So we might see this for a few days, and if we do see some upward action, we could see this chart show some improvement. The slope oscillator, it's still positive, but it's declining after giving us a real extreme reading and now declining below its moving average and still has not dropped below this green line. The MACD is turning more negative now. It's dropping below its moving average. So all of our oscillators, here's the slope oscillator coming down after being extreme, starting to roll over and go below the moving average with the TSI, the MACD. The PMO is rolling over but hasn't crossed yet, where the PPO has. We're rolling over with the TRIX, our longer-term oscillator, and we're crossing below the moving average with the KST. So we're still seeing a rather mixed picture right now with our momentum. We're still above all the moving averages, though, in our moving average tree. And the bullish percent index has not been able to get above 70. It's hanging in there for right now. This has been positive, but if we break above the 70 level, that's when we're looking for it to potentially top out, turn around, come back down. And when it crosses back below 70, that's a more negative sign, if not an outright sell signal. The NYSE bullish percent index did tick down just a little bit, but it's still above 50. And the NASDAQ 100 bullish percent index starting to come down again. It hasn't crossed down to give an official overbought or sell signal yet. If we have an up day, this might be able to turn back up. If we have a down day, this might generate a sell signal. The Chaikin oscillator is declining, but still above zero. That's still positive. The money flow index is showing some improvement. It had been declining. Now it's turning back up and is above 50. That's positive. And we're seeing that same thing with the ultimate oscillator, above 50 and back to advancing. The vortex is still positive because the green line's on top and it ticked up just a little bit. We were working off of this extreme reading now. So this could end up being healthy if we do break to the upside. We have some room to run with the green line. If we have a down day, we're going to see the green line decline and probably the red line come up, and at some point they will cross. The RSI based on 14 periods did turn up, but is not extreme, as well as the 9 period, not quite extreme positive yet. On balance volume is still above an advancing moving average. We turned up just a little bit with our 200-day moving average study with the stocks and the S&P, where we were pretty much flat with the 50-period moving average study. And then we don't have any Fibonacci charts to show now because we continue to be in no man's land, but we're still above this previous high and just treading sideways right now, wondering if we can go back and test this previous high here. If we see some weakness, we'll be waiting to see if we end up closing down below this previous high level. Our different charts, we're continuing to go more sideways with a slight positive bias with a hike in Ashy chart. The Kegi chart has turned more positive. It's black and started to point back up. The Renko chart is positive, but we're still looking a little bit negative with our 3-line break. I don't have any long-term charts. What we're battling with right now is pretty much in the short term. Until that gets worked out, the intermediate term and the long term, they're still hanging in there. But if we switch more negative in the short term, that's going to affect the intermediate term, which may end up affecting the long term. Looking at some other indexes, we did see a move up with the equal weight index, but it's still underperforming when we compare it to the S&P 500 weighted index. We came up just a little bit with our ratio, showing that the mega caps slightly outperformed the rest of the market. We were up slightly with the Dow. The transports and the utilities declined slightly, but the transports are still underperforming the Dow. And the transports are also underperforming the S&P. We want to see this ratio going up. It's now continuing to go down. The Dow is pretty much chopping sideways with everything else right now. The diamonds remain neutral. And we're chopping sideways and getting more to the upper part of the range for the NASDAQ. And we're also coming back up into kind of the middle to upper part of the range for the NASDAQ 100. The QQQs, they had switched to negative. Well, with the up day being up 1.4%, we switched back over to positive with the Elder's Impulse system. And we're showing more negative momentum now with the NASDAQ 100. The PPO is crossed below its moving average, and this is now declining. The small caps are chopping around. We had some good up days. We gave part of it back. Then we had an up day, then a down day, then an up day. They were up over 1%, but until we can break out above this R1 level, that's going to be difficult for the small caps. In the longer term, we're still working off of a downtrend. When we look at the Russell 2000 small caps, we did turn back up with the RSI, but we're not extreme. We're still below this resistance level. If you're into the Russell 2000 small cap index, personally, I would wait to see if we could close above this resistance level, because we've been having a really difficult time, not only right now, but this has happened previous times. This line's been on this chart for quite a while. But on a momentum basis, the MACD is rolling over just a little bit, but we're still positive. We continue to be neutral for the small caps when we look at the Elders Impulse system. And we're kind of chopping back up into the middle of the range with the mid caps. And we continue to be neutral with the mid caps. Looking at the Elders Impulse system, we were up about 0.5% with the financial sector. And so we're seeing a little bit of an improvement there. The micro caps were up almost 1% and continue to break further above 100. We're also starting to get above its 200-day moving average, so that could be more positive. The FANG index had a good day, up almost 2%, so it recouped some of the losses that have been drifting lower here. We are in a longer-term uptrend because the blue line is above the red line, and shorter term, we could be showing some improvement because we're still above the 50-period moving average. But we're not back to this previous all-time high yet. We can sometimes get there on an intraday basis, but we want to see this break above it and close above it. I wanted to show this because the bank ETF is giving us a golden cross. It just took a dump last March, went sideways, was looking very negative. Finally, we're seeing some improvement here. And so we're seeing this golden cross as price has been able to get above both moving averages. The dollar was up slightly and continues to be in a longer-term uptrend. Looking at bonds, we were up slightly with the 10-year yield, so we were down slightly based on price with the 10-year ETF. And we're still at a line here with the 1-month yield, and we subtract the 3-month yield. It's still giving us a positive 0.09 reading. And then an update of our growth to value ratios. We did see some improvement with the Qs to S&P, also some improvement with discretionary to the S&P, and large cap growth did outperform large cap value when looking at this chart. So with the large caps, we're seeing some improvement, still seeing weakness with the mid caps and the small caps. And we're still camped out in an extreme positive reading with our 10-day average of the S&P 500 highs minus the lows. And we're still above zero when we look at the 5-period moving average of the highs minus the lows for the Amex, NASDAQ, and NYSE. That's broader market positivity there. We continue to advance with our 50-period exponential moving average of the new highs minus the new lows because our indicator is still above zero. It has been coming down, but it's still above the moving average, which is causing the red line to continue to advance. The 2-year Treasury yield, we're still waiting to see what's happening here. Maybe we've spiked out and are starting to come down, which can give support to the S&P, but we're not seeing an awful lot of follow through more than just one day right now with this. I still haven't received the research that Tom Bowley has done for the month of December. I just kind of have to wait for that email. It's just a free email that he sends out. So what's our outlook for Friday? Still dealing with earnings season here and there. Still looking at all the different geopolitical events. The technicals are positive. On one hand, you can say we've been working off being overbought. On the other hand, we do see some potential weakness developing. On another hand, you could say, well, maybe we're going to turn more negative now. But the one thing that I'm noticing is that we are really range bound for the time being. We will get the employment situation report on Friday and the consumer sentiment on Friday as well. And then we keep an eye on all the different geopolitical events. Anything can break and have an impact on the market. We'll finish out the calendar, and when I do Monday's video, I'll have the updated calendar for next week when we look at the economic reports. Seasonality for December 8th, we are neutral to positive with the Dow and S&P, where the NASDAQ tends to be more positive. It's up 61.9% of the time. And we're wondering, is the January effect going to kick into gear? This is a ratio between the small caps and the large caps, where from 1979 up to 2022, we have seen a real upward movement here. I'm not really seeing much of that yet, but this tends to develop more in the middle part of December. We will be on the 6th trading day of the month, where we look at the green dashed line. We do see a little bit of positive action there. And then we'll be on December 8th, where we're still seeing some positive action as well here, looking at this Carson chart. But be aware, after this, sometimes this is when we historically can see some weakness before we tend to bottom out around the 15th of December. And we will be on Fridays, at least we'll be open for Friday here, where that tends to be the second most positive day of the week. We're up with a 53.9% gain on Fridays in 2023. But then looking at all of our different seasonality charts, have we finished going down with this little retracement here, the green line, or is there still more to come with this? We're also wondering where we're at with this other seasonal chart, as well as this seasonal chart and the other seasonal chart. And are we going to ever get beyond this historical seasonality here, where we do see some weakness in the early part of December before things tend to turn more positive? And then looking at the equity clock chart, that comes a little bit later. So according to this chart, we still might see some more weakness going forward, at least for the short term. But when we look at the Stock Traders Almanac statistics on the NASDAQ, we don't really see any major declines here. We do see some declines with the S&P 500, wondering at some point, are we going to get beyond that? So our scenarios, we're not going with the downwind yet. Yes, there might be some weakness developing. Yes, we're working off being overbought, but most of our charts are still positive. There are a few that are negative, but we're not seeing an awful lot of confirmation with that. So if anything, we're going with the up scenario for right now, because our charts are much more positive right now than negative, and we're at the top end of this trading range. As frustrating as it has been, even though the market has been going sideways, the ADX indicator has not been picking that up, but we still would not go with the sideways trend, because if you rely on indicators to help you determine what to do, it's still suggesting that we are in a trending environment. So the warning signs, we're keeping an eye on the risk on to risk off posture. It showed a little bit of an improvement on Thursday, but then who knows? It might show some weakness on Friday. Our momentum oscillators are mixed now. Some are positive, some are negative. The parabolic SAR for the second day now has been negative. The copy curve is negative, and we're still dealing with longer-term downtrends with the Russell small cap index and the mid caps. The daily special K chart, it is rolling over a bit, but it's still positive. The 5-period equity put call ratio is now chopping around. We're wondering, is it getting to an extreme reading? Now, it could still drop further from where it's at right now. We just want to note that sometimes this is where we get extreme with these readings, but we're looking more positive with our longer-term equity put call ratio. And our S&P 500 oscillators are mixed, where the NASDAQ 100 oscillator is actually turned over negative now. The vortex is positive. The green line's coming down, so it is showing some weakness, but we are still positive overall. The bullish percent index, it's still been hanging in there. It hasn't given us an extreme reading yet, and it continues to be positive. And small and mid-cap growth, we're just chopping sideways with those ratios. The financial sector is working off of a positive uptrend. I guess, is there a negative uptrend? Anyway, it generated a golden cross recently, and our 50-period new high, new low study is continuing to show some improvement. So our conclusion, we're positive, but you could say that we still have some of this overbought condition to work off. You might go a little more negative and say that's the way we're turning. We're still wondering, is this seasonal assumption going to come into play? Because so many people are just expecting this to happen. But in the meantime, we continue to be range bound. So in the short term, we can pretty much say that same thing. Intermediate term, we're still working off some overbought conditions. Is that turning over into weakness, mainly because of the parabolic SAR? And we're not going to be able to see the bottom part. I forgot to adjust that. We're still positive in the long term because we're above the 200-day simple moving average. Thank you. I really hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.